Beat Wall Street by using these candlestick patterns. Your portfolio times 100. Are you curious about candlesticks and how they can provide valuable information about asset price movements? Well, let's dive into this fascinating topic. Candlesticks serve as a visual representation of an asset's price fluctuations, offering traders a quick and insightful analysis tool. In today's video, we will be exploring the 3 key features that make candlesticks so captivating. But first, what are candlesticks? Candlesticks are a popular way to analyze an asset's price movement. They provide quick and insightful information using just a few bars. Imagine a chart where each candlestick represents a single day of trading. Now, let's dive into the 3 key features of a candlestick. First, there's the body, which shows the range between the opening and closing prices. Have you ever wondered how traders determine this range? Next, we have the wick, also known as the shadow. It reveals the highest and lowest prices reached within the day. Can you guess why this information is important for traders? Lastly, the color of the candlestick tells us the direction of the market movement. Green or white signifies a price increase, while red or black indicates a price decrease. Do you think this color coding makes it easier for traders to interpret the market? As time goes by, these individual candlesticks create patterns that traders can use to identify major support and resistance levels. Some patterns reveal buying and selling pressures, while others indicate continuation or market indecision. Can you think of any specific candlestick patterns that might provide valuable insights? Remember, before you jump into trading, it's essential to grasp the basics of candlestick patterns. They can greatly influence your decision-making. Are you eager to become adept at reading candlestick patterns? The most effective way to master this skill is through hands-on practice, where you enter and exit trades based on the signals these patterns provide. When using candlestick patterns, remember that they work best when combined with other technical analysis tools. This helps confirm the trend and gain a deeper understanding of the market. These patterns often appear after a downward trend, suggesting a possible price reversal. Traders can seize this opportunity by considering long positions to benefit from the unexpected upward movement. Number 1. Hammer. The hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downward trend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Number 2. Inverse hammer. A similarly bullish pattern is the inverted hammer, the only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. Number 3. Bullish engulfing. The bullish engulfing pattern is formed of 2 candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. Number 4. Piercing line. The piercing line is also a 2-stick pattern, made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed up to or above the mid-price of the previous day. Number 5. Morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a 3-stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies, as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. Hey traders, ready to level up your game? Our subscription is your ticket to trading success. Get exclusive access to expert techniques, in-depth analysis, and a vibrant community of traders. Hit that subscribe button now and join us on this exciting journey. Now that you're familiar with these bullish candlestick patterns, you have an arsenal of tools to analyze market trends and make informed trading decisions. Let's delve into 3 captivating bearish candlestick patterns that often emerge after an uptrend, indicating a potential point of resistance in the market. These patterns tend to evoke a sense of pessimism among traders, leading them to close their long positions and consider opening short positions to capitalize on the anticipated price decline. Number 1. Hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Number 2. Shooting star. The shooting star is the same shape as the inverted hammer but is formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. Number 3. Bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement and is a sign of impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Let's now explore 3 captivating bearish candlestick patterns that often emerge after an uptrend, indicating a potential point of resistance in the market. These patterns tend to evoke a sense of pessimism among traders, leading them to close their long positions and consider opening short positions to capitalize on the anticipated price decline. Number 1. Evening Star. The evening star is a bearish pattern formed by a short candle between a long green candle and a large red candle. It indicates a reversal of an uptrend, especially when the third candle erases the gains of the first. Number 2. 3 Black Crows. This pattern consists of 3 consecutive long red candles with minimal wicks. Each session opens at a similar price to the previous day, but it closes lower, suggesting a bearish downtrend. Number 3. Dark Cloud Cover. The dark cloud cover pattern signals a bearish reversal. It comprises a red candle opening above the previous green body and closing below its midpoint, indicating the bears taking control. Number 4. Continuation candlestick patterns. If a candlestick pattern doesn't indicate a change in the market direction, it is known as a continuation pattern. These can help traders to identify a period of rest in the market when there is indecision or neutral price movement. Number 5. Doji. When a market's open and close are almost at the same price point, the candlestick resembles a cross or plus sign. Traders should look out for a short to non-existent body with wicks of varying length. The doji's pattern conveys a struggle between buyers and sellers that results in no net gain for either side. Alone, a doji is a neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. Number 6. Spinning Top. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates an indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher while the bears pushed it low again. Spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come as it signifies that the current market pressure is losing control. Number 7. Falling 3 methods. 3-method formation patterns are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the falling 3 methods. It is formed of a long red body followed by 3 small green bodies and another red body. The green candles are all contained within the range of the bearish bodies. It shows traders that the bulls do not have enough strength to reverse the trend. Number 8. Rising 3 methods. The opposite is true for the bullish pattern, called the rising 3 methods. It is comprised of 3 short reds sandwiched within the range of 2 long greens. The pattern shows traders that despite some selling pressure, buyers are retaining control of the market. And there you have it, traders. Candlestick patterns are powerful tools to predict market trends, but remember to complement them with other analysis methods for a comprehensive understanding. Thanks for tuning into our candlestick pattern discussion. Don't forget to subscribe to our channel for more insightful videos like this. Hit that like button and leave a comment below to let us know your thoughts on any specific topics you'd like us to cover next. And don't forget to check out our other videos for a wealth of trading knowledge. Until next time.